Hello and welcome to our market alert video for today, which is September 22, 2023. And of course, this is the week where we got the information from the Federal Reserve, so I want to dive into that. But first, let me tell you, I am Ken Moraith, and I'm the founder and CEO of Retirement Planners of America. And we're a firm that specializes in, I think, the most wonderful thing in the world. Our goal is to create as many squippers as possible. And if you're wondering what a squipper is, it's a client of ours that is enjoying their second childhood without parental supervision. So squipper is the acronym for that. So go to our website. It's rpoa.com if you want to find out more. So let's talk about what happened this week. So a lot is going on. I've entitled this video, What Could Go Wrong? Because our fearless forecast for this year, in case you didn't know, was that inflation would come down and bottom in June at around 3%. And in fact, that's what it did. We then said that it would trend back upwards towards 4%. And in fact, what it has done is it's already at 3.7% as of August. And so now it looks like it may actually trend back up towards 5%. And so therefore, our fear is that the Federal Reserve is now going to have to raise interest rates some more to keep this economy from overheating. It just seems like they can't get it under control. And so that's one thing that is what could go wrong, is that the Fed can overdo it, can raise interest rates too high. So I'll get into that in a moment. The second thing, of course, is that's been in the news, which is the strike by the United Auto Workers. And that could be significant because that's thousands and thousands of people. But it's more than just the jobs and the people that are on strike and all of that. It's also the layoffs that are ensuing, but also it's the profits that those companies are making, which drive a great deal of our stock market returns. So you got that. And if that wasn't enough, then you also have that it looks more and more like we're going to have a government shutdown. Our friends in Congress and the president, the Democrats, the Republicans, they're having a hard time figuring out, how to get this budget thing going and get past it without shutting down the government and all of that. So we got a lot of stuff that could go wrong. So let's start with the last two, and that is the government shutdown and also the UAW strike. The UAW strike, in our view, probably will resolve itself within the next week or two. Neither side can win a long-term battle on this. The UAW has $850 million in their fund, and they have to pay the unemployment for these people that are on strike and the people that get laid off, and they can blow through that money pretty quickly if it becomes a big strike. And on the other side of it, the automakers don't want to lose all those profits and the billions of dollars that go with that. So they don't want to do it either. So we think that this is going to resolve itself. It'll get ugly first, and then it'll resolve itself. The government shutdown could be problematic. We have some history to look at. We have when Donald Trump, and we have other periods, it's not a frequent thing, but it's happened before, where the government is shut down. And it did cause the market to go down significantly, but it rebounded pretty quickly from that. So we don't anticipate that those two things, as much as the headlines are going to make you think that it's a big deal, that those are the things that we should really worry about if we want to worry about something. What we think you should keep your eye on is the Fed. Because if the Fed raises interest rates too high, they could create a very bad recession. And if they create a bad recession, then we could have a bad bear market. And the bear markets created by recessions last a while, and they're not nice. They're bad, okay? So we don't want that. And so what we're hoping is that the Fed does not have to raise interest rates too much more. Now, given that inflation is rising as we thought it would, two things. One is we think that inflation towards the second quarter of next year will have peaked, and that the Federal Reserve's job will be at that point to say we're done raising interest rates, we're going to start maybe even lowering them. So that will be a fantastic situation, because in that scenario, the stock market should go very high, and we'll get into bonds in a moment. But bonds should benefit from it also. The stock market tends to be 6 months in advance of when something happens. So if that's going to be the case, which means the second quarter of next year, then 6 months from then is this year. And investors buy ahead of the news, not after the news, generally speaking. And so what happens then is that they should be buying towards the end of this year. So the correction that we said we would see, we called it the inflation shock, is happening. We saw this week how the market went down quite a bit. So we're having that inflation shock. But we think this will pass. Investors will digest that, and then they'll start buying on the anticipation of next year being a good year for stocks. And therefore, we think that we should end the year higher than we are today. On the bond side, we still don't think it's a good place to be in bonds. As you guys know, we've been out of bonds since April of last year. And the reason why is because as the Fed raises interest rates, bond prices tend to fall. And bonds have not done well since last April. Check your portfolio if you own bonds. You'll see you've probably lost some money there. And so we don't want that. And so until we feel confident that the Fed is done raising rates, we're not ready to go into bonds. We'll be late to the party, but we'd rather be late than early and be wrong. So we're going to be right now sitting in cash money market funds, and they're paying 5% at this time. So that's not a bad thing to be paid while you're waiting for the storm to pass. So that's where we are. Now, having said all of that, we could be wrong. And what we could be wrong about is that we do, in fact, have a big bad bear market. We don't think we will, but we could. The debt ceiling thing could turn out to be terrible and cause a big bad bear market. And the UAW strike, we don't think it's going to be a big impact on the economy, but it could be. And if that does, then all three of them at the same time could be very detrimental. Therefore, we plan for the worst. We assume the worst is going to happen. And therefore, and we hope the best happens, right? We plan the worst, hope the best, not the opposite, which is to plan the best, everything's going to be fine, and then and hope the worst doesn't happen. We don't think that's prudent. So we have our sell strategy that we use, and as you guys know, we sold in November of 2007, prior to the stock market crash of 2008. Our strategy told us to sell, and then last April, our strategy said to sell out of our stocks at the same time. So therefore, we think that protection of principal is job number one. Yes, growth is important, but protection of principal is even more important, especially for those of you that we want to work with. And those are people that are over 50 who are retired or retiring soon. So we want you to be a SCWPer. We don't want you to worry about this stuff. We want you to have your second childhood, and we want to worry about it for you. So go to our website, learn about us. If you don't know already, visit with one of our retirement planners, attend one of our seminars. We want to help you if we can. All right, so thank you for watching this video, and we will talk soon.